What if the market everyone calls risk-free is the exact thing quietly lighting a fire under gold and silver right now? If you want more clean, no fluff breakdowns, subscribe, turn on notifications, and type Metal Guy Locked in the comments so I can see who's following the series. Welcome back, guys. It's the Metal Guy here. Hope you're having a great day. If you're here for facts over hype, tap like, subscribe, and switch notifications on, because metals don't wait for headlines. Now let's get into what's really going on, because what you're seeing in gold and silver right now is not random, and it's definitely not just speculation. We're sitting in a moment where gold is trading around 5,250 an ounce, and silver has surged beyond 110. To most people, this looks shocking. To others, it looks like a bubble. But when you strip away the noise, the move actually makes sense. And the real driver behind it is something very few people are talking about openly. Many longtime market observers have argued for years that precious metals aren't just commodities. They're insurance against systemic stress. The idea isn't new. But what is new is how close the global financial system appears to be to testing that thesis in real time. For decades, the dominant strategy of governments, especially the United States, has been to rely on debt expansion to maintain growth and living standards. The assumption has always been that this could continue indefinitely. Roll the debt, issue more bonds, push the problem forward. That strategy worked until it didn't. What a growing number of analysts have believed for a long time is that the real breaking point wouldn't come from a sudden collapse. It would come from loss of confidence, not a bond market failure, but a bond market fragility. That distinction matters. A collapse is obvious. Fragility is subtle. It's the sense that the machine still runs, but it's running rough. The global financial system is built on the idea that U.S. Treasury bonds are the ultimate risk-free asset. Governments hold them. Corporations park capital in them. Institutions treat them as the foundation of balance sheets worldwide. Trillions upon trillions of dollars rest on the assumption that U.S. debt is untouchable. But here's the uncomfortable truth. The moment that assumption is questioned, even slightly, everything changes. Gold doesn't rise because people are optimistic. Gold rises when certainty disappears, when the ground stops feeling firm. What we're witnessing right now isn't just fear, it's anticipation. Markets are starting to price in the idea that the bond market doesn't need to collapse to cause chaos. It only needs to become unstable enough that investors start asking, what if? And once that question enters the system, capital starts moving. This is why focusing only on inflation misses the point. Inflation is visible. Bond fragility is not. It operates quietly beneath the surface in parts of the system most people never look at, until suddenly they're forced to. Another overlooked factor is the changing role of the United States in the global economy. For decades, the U.S. represented nearly a quarter of global GDP and acted as the unquestioned center of financial gravity. If that dominance weakens, even marginally, the implications are enormous. Because when the world's reserve currency issuer no longer looks unshakable, the definition of safe assets must be rewritten. And that's where gold and silver step back into their historical role. This isn't about short-term price targets. It's about outcomes. Many seasoned investors don't position themselves for next quarter or next year. They position themselves for the moment the system is forced to reprice risk across the board. That's the prize. Now let's talk about silver specifically, because silver behaves very differently than gold. Silver is smaller, thinner, and far more volatile. When it moves, it doesn't tiptoe, it explodes. What triggered silver's recent surge wasn't hype, it was economics. At lower prices, silver miners struggled. Margins were tight, projects were barely viable, but once silver pushed past key thresholds, the entire industry flipped from survival mode into profitability almost overnight, and when that flips, behavior flips too. That shift matters because mining is a cash flow driven business. Unlike tech or consumer stocks, mining companies live and die by free cash flow. They must constantly reinvest to replace reserves, expand operations, and build new mines. That's why traditional valuation metrics don't work well here. What matters is how much real cash these companies generate after costs. And right now, those cash flows are just beginning to show up, which tells us something critical. This bull market is still early. In previous cycles, mining stocks didn't peak when metals prices first surged. They peaked later, when valuations stretched, when multiples expanded, and when speculation reached a frenzy. None of that is happening yet at scale. What we're in right now is the normalization phase. Metals prices rise first, and equities slowly catch up. That gap won't stay open forever. Once the market fully realizes how profitable these companies have become, capital floods in. That's when valuations reset higher. Not because of hype, but because the math demands it. And after that comes something else entirely. But before we get there, we need to understand how investors are positioning. why some are still accumulating aggressively, and why selling too early could be the biggest mistake of this cycle. They assume that because prices have already moved, the opportunity is gone. That mindset comes from stock market conditioning. Buy early, sell quickly, move on. But precious metal cycles don't work like that. They unfold in phases. And understanding those phases is the difference between exiting too early and riding the real move. Phase 1 is disbelief. That's when metals quietly start rising and nobody cares. Analysts dismiss it as a temporary hedge or a reaction to headlines. That phase is long gone. Phase 2 is recognition. That's where we are now. Prices are high enough that people are forced to pay attention, but not high enough to trigger mass participation. Investors start asking why metals are rising instead of whether they should be rising. Phase 3, the most explosive phase, comes later. That's when capital doesn't just trickle in, it rushes. What triggers that final phase isn't price alone, it's policy response. When governments are forced to choose between protecting bond markets or protecting currencies, they always choose bonds. Why? They understand that once silver enters the public consciousness in a meaningful way, supply becomes irrelevant in the short term. There simply isn't enough metal available at current prices to meet a surge in demand. Now add the industrial side of silver, and the picture gets even more interesting. Silver isn't only a monetary metal, it's a critical industrial input. Solar panels, EVs, electronics, medical applications, all of these sectors are growing at the same time. Unlike gold, most silver used industrially gets consumed, not stored. That creates a structural problem. You can't switch industrial demand on and off without consequences. If silver prices rise sharply, manufacturers don't suddenly stop producing solar panels or electronics. They absorb the cost, at least at first, because silver is a small percentage of the final product cost. But that absorption tightens supply even further. So while investors accumulate silver as protection, industry competes for the very same ounces. That tug of war creates sustained bull markets, not just brief spikes. Now circle back to miners, because this is where leverage shows up. Mining equities don't just track metal prices, they amplify them. A 20% move in silver can translate into a 50%, 100%, or even 200% move in the right mining stocks, depending on cost structure and reserves. But leverage cuts both ways. That's why smart capital is selective. Investors are favoring companies with low all-in sustaining costs, safer jurisdictions, strong balance sheets, and long mine lives. These companies aren't chasing production at any cost. They're optimizing margins, returning capital to shareholders, and positioning for longevity, not just the next quarter. And here's something most retail investors miss. Mining CEOs have lived through multiple cycles. They remember what happens when you overexpand at the top. That's why many stay cautious even with record cash flows. They're preparing for volatility, not assuming a straight line higher. That restraint is healthy. It keeps the bull market alive longer. Now let's deal with the elephant in the room, profit taking. Yes, some investors are trimming portions of their holdings. That's normal. That's smart. But wholesale exits, those are rare among seasoned participants. Why? Because the original reasons for owning metals haven't changed. They understand that once silver enters the public consciousness in a meaningful way, supply becomes irrelevant in the short term. There simply isn't enough metal available at current prices to meet a surge in demand. Now add the industrial side of silver, and the picture gets even more interesting. Silver isn't only a monetary metal, it's a critical industrial input. Solar panels, EVs, electronics, medical applications, all of these sectors are growing at the same time. Unlike gold, most silver used industrially gets consumed, not stored. That creates a structural problem. You can't switch industrial demand on and off without consequences. Debt levels are higher, currency confidence is weaker, geopolitical risk is rising, and trust in institutions is fragile. Those aren't short-term problems. The biggest mistake investors make is thinking that high prices mean the danger has passed. In reality, high prices often reflect high stress in the system, stress that still hasn't resolved, which brings us to the most important point of all. This metals bull market is not being driven by greed. It's being driven by preservation. Preservation of purchasing power, preservation of optionality, preservation of sovereignty, both personal and national. That's why this move feels different. It's quieter, more deliberate, less euphoric. And that tells you something powerful, but there's still one layer we haven't fully explored. Who is accumulating behind the scenes? Why physical metal matters more than paper claims? And how this cycle could end very differently from the last one. Behind the price action, there's a quiet accumulation phase that most retail investors never see in real time. This isn't driven by headlines or social media sentiment, it's driven by sovereigns, central banks, and institutions making long-term decisions about reserves, security, and strategic materials. Central banks don't chase momentum. They move early, slowly, and deliberately. And when they accumulate precious metals, they do it for one reason: trust erosion elsewhere. Gold has been the main beneficiary of this shift, but silver is increasingly being pulled into the same conversation, not as a reserve currency replacement, but as a strategic resource. Its dual role as both monetary metal and industrial input makes it uniquely valuable in an era of technological competition and energy transition. What's different this time is how the metal is being acquired. In previous cycles, demand was heavily paper-based. ETFs, futures contracts, and derivatives absorbed most of the capital flow. Today, there's a noticeable preference for physical metal: bars, coins, direct offtake agreements, long-term supply contracts. Why does that matter? Because paper silver can be created in unlimited quantities, physical silver cannot. That creates a growing disconnect between the price discovery mechanism and actual availability. When too many claims exist on too few ounces, stress builds quietly until delivery matters. That's when markets change character. We've already seen early signs: delays in delivery, rising premiums, shrinking inventories, increased leasing activity. All of these point to a system under pressure. None of these individually scream collapse, but together they tell a story. Physical silver is being spoken for, and once confidence in paper claims weakens, the repricing can be sudden. This is also where the industrial angle comes back in a big way. Governments around the world are prioritizing supply chain security, energy independence, domestic manufacturing, strategic stockpiling. These are no longer optional. They're policy objectives. Silver sits right at the intersection of all three. You can't build solar capacity, electrify transport, or expand advanced electronics without it. That means silver demand is increasingly policy-driven, not discretionary. And when demand becomes policy-driven, it becomes price-insensitive. That's a dangerous setup for a market with limited supply growth. Now let's talk about what actually ends a metals bull market, because this is where most people get it wrong. Bull markets don't end because prices are too high. They end when the underlying problem is resolved. For metals, that would mean credible debt stabilization, restored confidence in fiat currencies, and positive real interest rates sustained over time. None of those conditions exist today. In fact, we're moving in the opposite direction. Debt continues to expand. Real yields remain under pressure. And geopolitical fragmentation is accelerating, not easing. That suggests this cycle still has room to run, even if violent corrections show up along the way. Corrections are not the end of bull markets. They're how bull markets reset. Smart money uses volatility to reposition, not to exit entirely. That's why the focus shouldn't be on calling the top. It should be on understanding the signals that matter: broad public participation, extreme valuation multiples, aggressive mine expansion, widespread leverage, speculation. We're not there yet. Most people still don't own silver. Most portfolios still carry zero allocation to precious metals, and most media coverage still talks about metals like fringe assets. That alone tells you a lot. So where does that leave the average investor? It means thinking in terms of allocation, not prediction. Metals aren't about getting rich overnight. They're about staying solvent and staying flexible during systemic transitions. Physical metal provides optionality. Quality miners provide leverage. Patience provides the edge. This is not a market for all-in bets or emotional decisions. It's a market for understanding cycles, respecting risk, and letting time do the heavy lifting. And if history is any guide, the real payoff doesn't come during the loud phase. It comes after years of quiet accumulation. To wrap this up, the metals bull market isn't being driven by hype, fear, or speculation. It's being driven by structural change in debt, in policy, in energy, and in trust. Gold leads the move, silver amplifies it, and people paying attention now are positioning before the crowd realizes what's already underway. If you value this kind of no-fluff metals logic, hit like, share it, and subscribe with notifications so the next signal doesn't pass you by. Like always, invest with hype, not logic. The Metal Alarm Desk is out and about. Let me know in the comments below. If the thing labeled risk-free starts wobbling, do you hold steady, add protection, or rethink it from the ground up? And why? Chuang Ti Di Duan.